Welcome back to Talk Tickers. This is the show where we cut through the noise of the earnings tape to get straight to the signal for the experienced investor.
And we have a big one today.
A monster on the slab, really. We are breaking down the fiscal year 2026 Q2 print from Microsoft.
And what a print it was. I mean, if you just glanced at the headlines, you'd think everything was fantastic.
Absolutely. But then you look at the after-hours tape, and it looks like someone just pulled the fire alarm.
Mm-hmm.
We're looking at a classic, almost brutal beat and drop.
It is. It's the big mystery of the week.
You've got a clean beat on the top line, a clean beat on the bottom line, record cloud numbers, and yet the market just decided to punish the stock.
It's a harsh reaction for sure, but it tells you something really important. The whole narrative on Wall Street has fundamentally shifted.
How so?
Well, for the last couple of years, the question has always been, is this AI demand real? Is it just hype?
Right.
Nobody is asking that anymore. The demand is obviously real. The new question is, okay, just how expensive is this race going to get?
And can we actually afford the physics of it?
Exactly. That's the conflict we're going to unpack. It's this Capex shock versus a slight but very important growth deceleration.
And when you say Capex shock, we are talking about $37.5 billion.
In a single quarter.
It's not a typo. I had to check.
It feels like one, but it's real. And just as that spending went vertical, Azure growth, it actually slowed down a tick. And that's a dangerous mix when you're priced for perfection.
Okay, so let's set the scene before we dive deep. The numbers dropped yesterday, January 28th. Microsoft closes the day around $481. And then the report hits. And in the after hours, the stock just tanks, down over 6%.
Yeah, it dropped about $29 to sit around $452. That is a huge move for a company this size. Billions in market cap just gone in it.
So let's look at what they actually reported, because on the surface, it was a really solid quarter.
It was. Revenue came in at $81.3 billion. That's up 17% year over year.
Which beat consensus by about $1 billion, right?
Yeah, a clean beat. And on profitability, adjusted EPS was $4.14. The street was only looking for $3.91.
Wow.
And net income was a massive $30.9 billion. I mean, in any other year, those numbers are a victory lap. The CFO is popping champagne.
But the champagne definitely stayed on ice this time. And I think the reason is hidden in those cloud numbers, specifically the rate of change.
You nailed it. It is the second derivative that always gets you, Microsoft Cloud revenue. It surpassed $50 billion in the quarter, up 26%. Huge.
But the number everyone watches, the one that's like the heartbeat of the stock, is Azure.
That's the one. Azure growth came in at roughly 39%.
Which technically was a beat, wasn't it? The whisper numbers were a little lower.
Technically, yes. The street was looking for like 37.8%, but, and this is a really big, but it is a deceleration from the 40% they posted last quarter.
And there it is, the bear signal.
That's it.
You're spending way more money to grow just a little bit less, percentage-wise.
Precisely. And the guidance for Q3 just made things worse. They're guiding revenue to what, between 80.7 and 81.8 billion.
Okay.
But the Azure growth projection is sitting at 37 to 38%, which implies, more deceleration or best case, flat growth.
So you combine a slowing growth rate with a massive, massive ramp in spending, and you get a sell-off.
You get a sell-off. The market can't underwrite the efficiency of that spend. Not yet, anyway.
Let's talk about that spending. We have to confront this Capex shock, because that number, it looked like it belonged to an energy company, not a software company.
$37.5 billion in Q2, up 66% year over year.
Just staggering.
And to put that in context for you, about 2/3 of that cash is going toward what they call short-lived assets.
Right, let's define that. When accountants say short-lived, they mean stuff that depreciates fast.
Yeah.
So in this case, we're talking about GPUs and CPUs.
Exactly. Servers, silicon, stuff that basically becomes obsolete in 3 or 4 years. They are not buying land that holds value. They're buying chips that depreciate like a car driving off the lot.
And they're doing it because, and this is the phrase management kept repeating on the call, demand exceeds supply.
Which is usually the most bullish thing a CEO can say, right? We have more customers than we can handle.
But this time the market heard it as an execution risk. Why the disconnect?
Because it means you're leaving money on the table. It means you physically cannot plug these things in fast enough to book the revenue.
It turns a growth problem into a logistics problem.
Yes. And what Satya Nadella described on the call wasn't software engineering. It was heavy industrial manufacturing.
This was the part of the call that really got me. He started talking about the Fairwater project. And suddenly we're not talking about code. We're talking about connecting Atlanta and Wisconsin with an AI van.
He doesn't mean a van down by the
I
river.
hope not.
No, it's some advanced networking architecture. They're basically treating data centers in different states as one single supercomputer. A first-of-its-kind AI superfactory, he called it.
And the buildings themselves are different now. He mentioned two-story designs and liquid cooling.
The liquid cooling is so key. You just can't cool these new high-density racks with air anymore. The physics just don't work. You need liquid.
But the statistic that just made my jaw drop was the power capacity.
The 1 gigawatt.
1 gigawatt of capacity added in Q2 alone.
Yeah.
So for anyone listening who isn't an electrical engineer, 1 gigawatt is roughly the output of a nuclear reactor.
Or enough to power, what, 750,000 homes?
And they added that to their grid in 3 months. And it's nuclear scaling, which brings up this other risk the analysts were poking at, the duration mismatch.
This is a classic accounting nightmare.
Right. You depreciate a building over 20 years. You depreciate a server over maybe 6 years. But the contracts they're signing with these AI customers, how long are those for?
The average duration is only about 2.5 years.
So there's the mismatch. You're stuck with the mortgage for 6 years, but the tenant only signed a 2-year lease. If the AI hype crashes in 3 years, Microsoft is left holding a massive bag of depreciating silicon.
Exactly. Now, Amy Hood, the CFO, she pushed back on this pretty hard. She said that for the GPUs specifically, they are essentially sold for the entirety of their useful life through these big contracts.
Which is another way of saying, don't worry, these chips will be junk in 2.5 years anyway, so the contract covers it.
It's a double-edged sword of a defense. It's reassuring on the accounting, but it just reminds you how fast this tech is moving. You are spending billions on hardware that's destined for a landfill in 30 months.
It's the Red Queen's race, running as fast as you can just to stay in the same place.
And speaking of hardware, this brings us to silicon independence. Microsoft isn't just a buyer from Nvidia anymore.
They're rolling their own chips.
This is maybe the most underappreciated part of the whole report. They are trying to defend their margins by vertically integrating. If you buy from Nvidia, you pay Nvidia's 75% gross margin. If you build it yourself, you keep that money.
They mentioned 2 new chips, right?
Yeah.
Maya 200 and Cobalt 200. Let's start with Maya. That's their accelerator.
Correct. The Maya 200. Satya said it delivers over 10 petaflops at FP4 precision.
Okay, hold on. FP4 precision. Can you unpack that for the non-technical crowd?
Sure. So FP is floating point. It's about how much detail the chip uses for math. FP4 is lower precision, so it's not great for training a model, but it is incredibly fast and efficient for inferencing.
So when the AI is actually answering your question.
Exactly. Maya isn't for learning, it's for doing. And the killer stat here was the TCO, the total cost of ownership.
Right.
Management claims Maya delivers over 30% better TCO than the latest third-party hardware.
30% is a huge number when your Capex is $37 billion.
It's billions in savings. And their CPU, the Cobalt 200, is delivering 50% higher performance than their first gen. They are trying to own the entire stack, from the power plant to the app. It's a classic defensive move against Nvidia.
But there is one part of the stack they don't own, and it is the 800-pound gorilla in the room, OpenAI.
The concentration risk. This is the other major point of anxiety driving the stock down.
I saw a number that really jumped out at me. It was about their backlog, their RPO. They revealed that 45% of their commercial backlog is tied to OpenAI.
45%. It's an astonishing number. Nearly half of their future committed cloud revenue is from one single company.
And it gets a little circular, doesn't it? Microsoft invests billions in OpenAI. OpenAI then uses that money to pay Microsoft for cloud services. Microsoft books it as revenue. It feels like a perpetual motion machine of money.
That's the round-tripping fear. Is the revenue actually real? Now, to be fair, Amy Hood did say that even if you exclude OpenAI, the backlog still grew 28%.
So the core business is still healthy.
It is. But you can't ignore that the headline growth number is heavily reliant on Sam Altman's success. They are financially fused at the hip.
And there's a weird accounting change there too, right? Something about the equity method.
Yeah, it just gets complicated. Basically, it made the bottom line look a little noisy and complicated. Clean beat. narrative. The big takeaway is just how intertwined they really are.
Okay, so let's pivot up the stack to the software. For the last year, all we've heard is Copilot. But listening to Satya this time, I felt a shift. We're not just talking about copilots anymore. We're talking about agents.
Agents are the new apps.
Yeah.
That was his quote. And it's a really important pivot. Copilot implies a helper, right? It sits next to you.
Right.
Agent implies delegation. You tell the software, go do this thing, and it goes and does it. It's the difference between a chatbot and an employee.
And the adoption numbers are there. 15 million paid Microsoft, 365 Copilot seats, up 160%. GitHub Copilot at 4.7 million subs, up 75%.
And Satya explained why these agents work better now. He used this term, the work IQ.
I like that concept.
It's the data layer. It's the AI's ability to reason over your company's specific data, your emails, your meetings. ChatGPT knows the internet. Microsoft's agent knows your company.
That's the moat.
Yeah.
And they had some big customer wins. Publicis buying 95,000 seats, Siemens rolling out to 30,000 developers. We're past the kicking the tires phase.
For sure.
So let's bring it all together. Mass deployment, record revenue, 30% efficiency on new chips. Why is the stock in the penalty box?
It's the ROI credibility test. The market has shifted from FOMO, fear of missing out, to show me the money.
The spending is happening now. The revenue from that spending happens later.
That is it in a nutshell. That $37.5 billion in Capex is cash out the door today. Monetizing those new agents takes time. Investors are looking at that 1 gigawatt expansion and saying, what if we build the nuclear reactor and nobody turns on the lights?
So Microsoft is evolving from a capital-light cloud compounder into a capital-heavy AI infrastructure builder.
And Wall Street hates capital intensity. They love high margins, low overhead. So the stock is just in a holding pattern until either Azure growth reaccelerates or Capex stabilizes.
All right, that covers the print, the physics, and the pivot to agents. Now we get to do the fun part.
I'll get the lawyers on standby.
Please do. This is our Trade Discs segment. And we have to say, this is absolutely not financial advice. We are not advisors. This is for entertainment purposes only. Don't trade based on this.
Okay, now that we are legally safe, what's the pitch?
I'm calling this trade the 1 gigawatt arbitrage.
Oh, I'm listening.
The insight is simple. Microsoft added 1 gigawatt of power in 3 months. They're building these Fairwater superfactories. And Satya specifically mentioned the Atlanta to Wisconsin corridor.
Right, you can't just put a data center anywhere. You need power and you need water.
Exactly. So the trade is, we go a long, long way. The hyper-local utility providers in those specific regions. I'm talking about the most boring, regulated utility stocks in Wisconsin and Georgia.
I see it. Microsoft has billions to spend, but they can't build a power plant overnight. The utility company is the gatekeeper.
The utility has pricing power. Microsoft needs the juice. You bet on the gatekeepers. It's a classic pick and shovel play.
I like it. But every good trade needs a short leg. Who loses here?
We go short the legacy box sellers.
The traditional server makers.
Yep. Think about those Maya and Cobalt chips. Microsoft is getting 30-50% better performance by building their own silicon. If all the hyperscalers, Microsoft, Google, Amazon do this,
then the total addressable market for generic off-the-shelf commodity servers just collapses.
Precisely. You short the guy selling carburetors right when fuel injection gets invented.
That is a brutal but elegant pair trade. Long the power, short the old hardware. You got an outrageous kicker for us.
Of course. The kicker is we buy leveraged futures on liquid cooling components.
Betting on the heat.
Satya said it's a high-density, liquid-cooled design. You can't use fans. If you want to bet on the physical constraints of this build-out, you bet on the plumbing. Specialized coolants, copper interconnects, heat exchangers.
I love it. It's speculative, it's wild, and it bets on the laws of thermodynamics winning out over software margins.
Physics always wins in the end.
So what's the final word for the listener?
Microsoft is building an engine the size of a city. The revenue is great, the profits are massive. But the fuel bill is terrifying the neighbors.
It is a brave new world of heavy industry disguised as a software company.
And we'll be here to break it down. Keep watching the ticker. We'll catch you on the next deep dive.